Welcome to the Money GPS. You came here for the bananas, so let me unveil that for you. I'm going to take it slow. I'm going to look at some information today. I've actually got very few charts because I want to show you what's happening and I want to really break this down. I hope you're well. Hope you will sit with me for a few minutes while we take a look at what I believe to be so key, so important. And it begins with this. Go back in the pages of history to the financial crisis and, of course, the housing crisis, and leading up into that, adjustable rate mortgages, ninja loans, all these different things that were happening surrounding the real estate market, and, of course, all the fraud that went around. At that time, it was pervasive. It was known, but it wasn't really known until it was too late. Adjustable rate mortgages are back, but they're not like you remember. Gone are the ultra low teaser rates and lax lending requirements. Today's ARMs are safer, and so are borrowers. Yes, that's right. That's what they're saying right now, and I'm sure that's true. I'm sure in the way that they are describing this, it is in fact true. Except there are many avenues here, many levels of this to the real estate market that aren't going to be shown in the exact same way as it was before. You got to understand when you add up this much debt, when you see what's happening here and all the fraud that's been happening ever since, we never left a lot of that fraud. There's always going to be that happening behind the scenes. But of course, it doesn't get known to the public until it's too late. And I'm going to show you some more information on that in the coming videos. If you want to stay tuned, all you got to do is hit that thumbs up button because the algorithm will be more likely to show you these videos. And this is really key because I'll reference this one in the future. Walmart, Gap, and others amass $45 billion in extra stuff to sell. Companies bulked up amid the lengthy shipping delays, which are still happening today. Shifts in consumer preferences may force a round of discounts. So I'm going to go through this, but this is why I've talked over and over and over again. If you resell these products, you could make a considerable amount of money. These retailers, whether it's, Sears going bankrupt and having to liquidate and other department stores, or in this case here, they've got stuff, they need to sell it, you can potentially buy it, and then resell it on Amazon. This is something I talked about many times before. I have an entire free course, which I'm going to get rid of, a free course selling on Amazon, theamazongps.com. Okay. Big retailers rushed to build up inventories last year amid soaring consumer demand and transportation bottlenecks, going so far in some cases as to rent their own cargo ships. Now they're trying to figure out how to sell all their stuff. You see what happens here? Some call this the bullwhip effect. You look at what happened, it was obvious. I talked about that before, like pulling the demand forward. Yeah, that's good in the short term, of course. It makes the economy look strong. You need employees, you need to ship stuff, all that. But what happens when that stops? Inventories rose $45 billion for companies on the S&P consumer indexes with a market value of at least $1 billion that reported earnings. That's up 26% from this time last year. The dented profits at some retailers, with Walmart paying for storage and Target and Gap cutting prices on key goods. So, of course, the consumer could benefit from this, you see, because they can go to the store, they can get discounts. That's great. But what does it do to the company? And you might say, hey, who cares about Walmart's profits, right? Obviously, nobody's going to shed a tear for Walmart's profits. But if Walmart and Target and Gap and all these other companies are not making those profits, suddenly they don't need as many employees. And so we can see what happens with the trends, and it is clearly there. We're starting right now to see the cracks forming, but only time will tell. It's far from clear what happens next. In the past, ballooning retail inventories have signaled economic slowdowns or recessions as shoppers bought less. And that's something that I talked about over and over again. You could see here Walmart, Home Depot, Target, Costco, TJX. Just some examples that they throw out here. Walmart on the top of the list. The just-in-time mentality is broken now. So you're seeing retailers carry more inventory than they traditionally carry. Look, I think this should happen anyway. I think we shouldn't have this whole just-in-time kind of system set up because it doesn't work. In some cases it can work, but overall, trying to do that way clearly has its problems. Clearly. Especially for something, look, if it's, some sort of gadget, you're trying to buy the new fidget spinner and it's going to take you a while to get it, it's okay. But if it's something critical, just in time is probably not a good idea. That's just the way I see it anyway. Okay, you're looking through here. I don't want to just go on forever and ever, but this is a problem for all these names: Costco, Macy's, and so on. So it's not just a holiday thing. It's not just, well, this is Q4. Generally, Q4, people are trying to move as much of that inventory in leading up to that as possible. I mean, there's a lot to that. It's not what's happening today. And so we need to look at these inventories. If the inventories start to deplete, then we know that the consumer demand is there and this is happening, the wheels are turning. But if we see that this is consistently a problem in the coming month, 2, 3 months, then we've got an issue. So I will give you the updates on that. Stay tuned. Why one CIO is waiting for a, quote, solid panic in the stock market. Market has held, but selling is not done yet. Says $90 to $100 a barrel for oil in the next 18 months is likely. There's a good point here. Do you think they've bottomed out? No, I don't think we've bottomed out. I just think we're not done yet. I think this is a little bit more of the first leg because I always ask, what is our catalyst? How are we going to get growth? You really haven't seen a lot of earnings revisions. And so we talk about valuations having to come down. Yeah, the P part of the PE has come down. But what happens when the E starts to go back down too? There's two parts to that. She goes on. So I think it's something that we should be keeping an eye on. Looking at earnings, looking at all of that, and understanding where is the consumer. Consumer sentiment has declined considerably because of inflation, and the expectations here is that inflation begins to subside. And I have said over and over again over the past couple months that certainly in the way that they measure it, we can absolutely see inflation coming down because we're not factoring in actual real inflation. So regardless, the market's going to react to the fake inflation, not the real inflation. And so we need to see what happens. And how does the Federal Reserve react to inflation? Well, according to this Bloomberg article, Fed won't flinch as labor market starts tailing off. Payroll is likely to show the smallest increase in just over a year. Bank of Canada hike is due. That's coming up soon. Euro area inflation may hit a record. So it depends on where you look, of course. But I just think it's interesting to see the way that this has been happening. I mean, look at the unemployment rate. I mean, it's 3.6%. And right here, 3.5%. We'll see. What I notice here is that the Federal Reserve is ultimately going based on this data that is false and is not a true representation of what's happening. But what will we see? Well, the expectation here is that June means, June brings us another 50 basis points. And the one that's becoming more up in the air is July. Another 50 basis points or not. So that's going to have an absolute impact on the stocks, on the economy as a whole. So keep your eyes peeled on this. U.S. wage increases show signs of peaking, a welcome sign for the Fed. Slower pay growth may help the central bank rein in inflation. So that's right, because of course, wage growth, oh, that's a bad one. They don't like to even look at it, though. The Fed says, no, no, we don't look at that stuff. But at the same time, of course, they do. Smaller firms are reaching limits on how much they'll pay out. You look at it. I mean, it's pretty obvious. The firms are being pushed to the edge. They're passing that on to the consumer. So you might be getting more. Let's say you just, for example, you worked at McDonald's. That company might increase your salary, but then you got to pay more for the McDonald's. You know what I mean? That's just the way it is. I wanted to show you this because one of the best indicators of where we are at is the amount of euphoria, is the amount of cash that floats around. And what I see right now, this is a cryptocurrency, Terra's Luna. So this is a cryptocurrency that went completely bust, and they started a 2.0 of that to try and resurge it. And it crashed 88% upon its launch. So you can see down here what happened. It launches, it goes from basically nothing, surges all the way up, and then suddenly turns around and absolutely gets crushed. Now, does that mean that tomorrow or next week or next month it's not skyrocketed from here? I don't know. I don't know. But what I'm telling you here is that the market is just wild. And until the point in which we've hit max fear, we've hit max pain, until we see people saying, I don't want to touch any of this stuff. Until we get to that point, it's not really over with yet. But like I said, I don't know what's going to happen. That's the mentality, the sentiment, and what we will see, okay? I wanted to give you an update here on the Fed's balance sheet. I even saw videos, at least the title of videos, saying the Fed's balance sheet keeps increasing. And I had said over and over again, it's going to fluctuate somewhere around the 9 trillion mark. Okay, because every month is different. And you could see up, it's down, it's up, it's down, it's up, and now it's slightly down. Okay. What we can see literally in just a few trading sessions is what they've said. They're going to start making this decline. How long that lasts for, I don't know. They're near 9 trillion. What they've been told is, 6.5 trillion by the end of their tightening cycle. Still ridiculous, still excessive. We will see what happens. Okay? And again, when you look at the euphoria, a lot of that is based on what the Federal Reserve has done. Their balance sheet, interest rates. Startup investors are warning of dark days ahead as boom times are unambiguously over. You look at this, venture capital funding has started to decline. They're starting to feel that fear because you look at the edges of whenever you want to see what's going to happen, you don't look at, let's just say Apple, okay? Because they're not on the edge. This is the core. But you look at that fringe, and that's how you get a sign of what's coming towards you. You see? That's just the way it goes. It's just the way it goes. And this is just one example of that. Okay. I think I made my point. I think that this just highlights something that, it's a different video than I normally do. I hope you appreciate it. I wanted to take my time with it, get into the explanations of it all. If you appreciate this information, simply hit that thumbs up button. I really do want to thank you for that. I'm trying to bring out information each and every single day. And like I said, I hope you're all doing well out there. I hope that while we can see some dark times, that individually, we can take care of ourselves, we can take care of our families, and be able to weather this storm and any future storm. So I wish you all well. Take care, and I'll see you on the next one.